Lots of news flow, so let's try and decode that with Mr. Sanjay Parekh, who's joining us from Soham Asset Managers. He's, of course, the founder and CIO there. Hi, Sanjay. Good to be speaking with you. Thanks so much for making time. Before I come to the market view and all of that, I wanted to narrow it down because a couple of these stocks just reported their numbers, M&M and Trent at that. Let's begin with M&M because you do have some auto exposure there. What's the story that makes you positive on that one? Because the stock is reacting positively to the beat that we have seen in Q2.
So, basically, thank you. So overall, M&M, we own it, and I'm not seeing the results very closely. But overall, we like it because, very clearly they're improving their presence in passenger vehicle segment. In a weak environment, they've increased their market share. Their product positioning is very, very good, and some of the products are done very well. And the tractor segment is clearly on a recovery path. And initial results that I saw, you can see that broadly, they have gained market share even in tractor segment, where the profitability is higher. So they have, improved the profitability. And as I initially said, definitely there's an upward surprise based on expectation as well. And still it is reasonable. So if you take the subsidiary value out and the core business of tractor, and the auto piece, the SOTP still has good room for upside if you look at 26 and 27. So we still like it and we own it as well in our portfolio.
Something that you find reasonable at this point of time, but can you say the same argument for Trent? Because on valuation yardstick, it's not reasonable by any yardstick, but the stock just continues to trend higher. Today, of course, it's down 5% because part of the street is disappointed with the top line performance. But any view on urban consumption or Trent specifically?
So Trent we don't own it and we missed out, and it's done very, very well. The exceptional, the longer term, the strategy around Zudio or across formats as West Side, they've clearly been outlier in terms of their performance, and that has been reflected in the stock price as well. And the inclusion in Nifty was also a result of that. So very clearly exceptional performance. I'm not talking the quarter, but clearly what constrained us was the valuation. And valuation is something which is discomforting at significant premium to even its own history. And that is where we are uncomfortable. But otherwise, absolutely kudos to the performance, the operational performance from them.
That was on stock-specific, your views on stock-specific ideas. Apart from that, how is the market looking like now? After 2 days of straight gains, we are again seeing a decline. Overall market continues to remain on a downward phase. FIs have been continuously selling. Valuations were expensive at one point of time, but they have now become relatively cheaper, at least for the large cap. So how are you positioning yourself in such volatile conditions in the market?
Yeah, so one is, just a little bit of a product. A product is where we have said always that we'll be at least in 70% in large cap. Right now, we have 73% large cap and around 21% in mid and small cap, when small cap is much larger and the rest is cash. So the way we think about it is earnings. One is, let's take the positives. The positive is all the balance sheets are in the best ever shape I have seen since 1994. The government balance sheet, we have operating leverage on fiscal space. RBI balance sheet is contracted, but they have enough space if they wish to, support liquidity. The balance of payment situation is best ever. The banking balance sheets are at a lowest credit cost. There could be some spike, but well in control. Corporate balance sheet is at the lowest leverage. And household balance sheet, I was just telling my client that we have a $2 trillion wealth effect because of real estate, equity, gold. So that is the best that we have. In terms of negatives, the lower segment of rural and urban India is clearly not spending. We have a slowdown. The earnings have disappointed. First quarter was weak. Second quarter also was quite weak. Then our preview also. So overall, there will be earnings downgrade. Nifty in this year should do more like 1,060, 70. Next year should now move more like 1,200. So at 1,200 rupees earnings for our interest rates, we're not very cheap even at current levels. So What I think from here is we're going to have some more time correction, and we'll see if we recover, which I think we will, as the government spend starts, because both on the monetary and fiscal side, there has been tightening. So as that gets, at least on the fiscal space, they start spending, we will see recovery in the fourth quarter. And, that is what we will look out for. And hence we believe that from here, there'll be some more time correction. We'll be in a narrow range. But the price correction from your current levels of Nifty, maybe 1 or 2 or 3%.
Right.
That will be a good opportunity to slowly accumulate. But expectations have to be that returns will be gradual from it.
Yeah, so downside is limited, but the return expectation needs to be moderated. But where are you putting money to work, Sanjay, then? Which sectors or segments look good to you?
So we are, what we're doing is in the larger cap space. In fact, this fall is giving us more opportunities. Our portfolio, in auto segment, we recently added Maruti. Financials, the larger names, all larger names we like. Axis Bank or SBI or ICICI Bank or HDFC Bank, all four are our large holdings. That is where at a right price, we would increase our weight. And then selectively in each of the bottom up, either in our portfolios that we like or any new insertions. But now in the fall, we clearly are seeing the opportunity on a bottom up basis getting larger, which is what excites us. In the mid and small cap, our threshold of returns and margin of safety will have to be much higher because the environment is not conducive, and hence you have to be having a little more conservative there.
So you also appear to be very overweight when it comes to the capital goods space, but private capex is yet to pick up, and we are seeing some signs of slowdown when it comes to government capex. Also the numbers for this capital good companies like Siemens, ABB were weak in the second quarter.
Yes.
What makes you so bullish when it comes to the capital goods segment?
Yeah, so one is it's a portfolio is a public domain. So Larsen and Toubro is a large holding where we feel it's very reasonable on valuation if you remove the subsidiary value for such a large conglomerate which is delivering growth and slowly could improve margins. They're very, very well poised. So this is what we own now for 2.5 years, and that is one that we like. InterArc is what we recently added, of course, at significantly lower levels. It's run up quite well. It's into prefab structure. It's a bottom-up stock picking that we did. And the opportunity is very, very large. The unorganized to organized segment, there is a shift and they are very well placed there. Which accelerates the setting up of factories and buildings that they are into. So that is, and they have a very, very strong clientele. And then we have Solar Wilson, which we think is a good play on renewables, going through a transition, but will do well. And the last we have is Dilip Bilkon, which may have a slow ordering, as you said, in the Q2 as well. But we surely believe that it will pick up. And as it picks up, it's very well poised. It's a real deep value where it's deleveraging. And then it's three businesses. One is the core EPC, the core MDO, and the investment in InvITs that they have. The combined SOTP in 1.5 to 2 years could be significantly higher, and hence we like it. So that's where we have bought each of them on a bottom-up basis. And we think the opportunity there is still larger, and hence our overweight.
Sanjay, for explaining, for giving us those details and explaining your perspective about the markets. With that,
if you like this video, then like, share and subscribe to ET Now.